Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello, everybody. My name is Debbie from NDIS Property Australia, and you're listening to the SDA Housing Podcast, a show that explains, highlights, guides, and brings awareness about all things SDA in this ever-changing NDIS world. And with me, a repeat guest speaker from Access Lending, Paul Grant. Welcome, Paul.
Good morning, Debbie. Nice to be here again. Thank you.
Yeah, we have, as I just said, the ever-changing landscape of SDA and within the NDIS. We've had some significant changes handed down by the major lender in the space in the last month or so. And I think we've got a bit more clarity on what they actually mean. So that is a perfect time for us now to speak to you, Paul, and get your feedback and just to run through exactly what this means now.
Okay, they'd be happy to do so. Yes. Okay, guys. So in October, the lender who specialises in NDIS properties did some due diligence on their book, and obviously they have hundreds and hundreds of NDIS properties either established or under construction. And looking, to be honest, some of these policy changes probably should have come about from day one when we first did NDIS lending, because it is complicated. It's not a normal investment property. It's got commercial nature to it, the tenanting requirements, etc. So some of these changes are most definitely for the better. They will certainly hinder some clients who want to get into this space. We can look at some options for those later anyway while we go through these changes. But basically, effective mid to late October, the following has applied. You used to be able to buy an NDIS property with a 10% deposit. Now minimum deposits required are 20%. Okay. They want these deals to be done in capital cities. They're not excited about small regional towns because obviously they are harder to tenant. So they've also brought in a postcode restriction for regional towns with a population of less than 10,000 and or further than 25 kilometres from a major regional town. It'll probably be really, really difficult to get that deal done because tenanting is more complicated in small towns. There are some other postcode restrictions effective immediately. I won't name the suburbs, but I'll quickly advise what those postcodes are. And most of them are in Melbourne, one in Adelaide and a couple in WA. So for Melbourne, 3024, 3029, 3217, 3338, 3753, 3978. No longer be able to do new construction loans in those postcodes. This will be revised in March next year. The WA ones are 6112, 6171, and for South Australia, 5113. They're deemed as an oversupply of properties in those locations, so they just want the market to settle down for the next 4 or 5 months. And as I said, they would revisit that in March next year.
That's good, Paul. I'm just going to jump in there. Look, these areas, for example, the postcodes in Melbourne are predominantly in the west, and we have known for quite some time that those areas, those greenfield estates, are significantly overdeveloped with SDA. So I think this is actually a really good thing because it's going to stop people going in who haven't necessarily done their due diligence and who have been sold the dream, sold the idea of a SDA property that's going to give them a great return, but are unfortunately going to be left with a vacant property.
Yes, and look, and the hard part, Debbie, as we've discussed previously at other events, the SDA certification traditionally does not happen till the end of the build. So when there are blocks of land out there that have been sold and slabs on them, you actually don't know if it's a first home buyer, an SDA purchase, a mum and dad owner occupier. You don't know till the certification comes through later on. And marketers don't know that either. That, you know, marketer number A sells Spike properties in Clyde, There's 8 other marketers all sell 5 properties in Clyde. They all don't know what each other's done because there's no real matrix for them to follow at this stage. The lender gets all these deals because they're the only ones doing it. So they have these figures, and hence why they've come down with some of those postcodes, because they know they've got 2 million in there at the moment.
Yep.
Other restrictions to apply. Only one NDIS construction loan per client at a time. So if you are an investor wanting to do multiple investments, and I've got some clients who've got 4 on the go at the moment, as of October, 1 only. That has to be finished, and then you can go again with a maximum of 2 per client. So if your dream is to have 5 of these things, at the moment you cannot. Maximum of 2 only.
So does that mean that if you own 2 outright, you don't owe anything on them, you still can't get a loan?
At the moment we can't get any more.
Wow.
Now, that's in policy that it's probably a little bit grey. If you've got 2 at the moment and they're fully tenanted and they're running really, really well, and you're on a high income and you've got good savings, well, I suppose we could build the argument to the lender that these ones are going well. They're not vacant properties. Your risk is minimal. We should be able to consider giving this client another one. If you've got 2 under construction and they're empty, obviously they're not going to give you a third one. So probably grey, and it needs a little bit of tweaking there, but at the moment it's 2 per client.
Okay, noted.
NDIS income. So they do accept the NDIS income in their servicing calculator, but they don't accept 100% of it. They're now using 70% of gross proposed rent in their servicing calculator. So they're just shaving that a little bit so that it's not.
And that is, I'm so glad to hear that, because the gross is almost never going to actually be reality.
No, exactly.
In these cases.
Yeah, as we know, 3-bedroom properties, get 1 tenant in there, you're going well.
Yeah, that's right.
And that's going to pay your mortgage. And if you get the second one in, then you've got some profit. Third one in, I haven't seen 3 of them done before. You may have, Debbie, but yeah.
Not a lot.
Okay. They also now want an SDA due diligence letter or engagement letter. So historically, investors have been put in contact with SDAs and seal providers at the end of the transaction. They now want you to be speaking to those groups at the start of the transaction to get comfort from the SDA that once your house is finished, they are going to be happy to help you tenant it. So that's a good initiative. You also, as an investor, now need to get an accountant's letter or financial planner's letter advising you on the risks that you are entering into and getting into an NDIS property. They are a must. You cannot have that. They are not waived.
Is there any other due diligence that an investor needs to show they've done?
No, those are the 2 things. There are some other things that the investor needs to know and to do. And from the way it sounds, the lender is wanting sophisticated, seasoned investors in this space. The first time mum and dad investor who decides they want to get into NDIS, and they've probably done really well. They've saved lots of money. They've got good jobs, but it is a complicated process. Tenanting is not simple. They're not looking at people who are putting in every single % of savings into this dream and things go bad, because there are empty houses out there, as we know. So you must have 20% deposit. In theory, you need to have a minimum of $250,000 in the bank. Okay, we were doing these at 10% 3 months ago when clients had $150,000 in the bank. They needed $140,000 to settle the transaction. It didn't leave them much left over to cover the interest payments for 12 months and to cover vacancy periods.
No, and look, we've been telling people for a long time now that they need buffer. They need that deposit, and they need way more. We've even been talking about having a minimum of $400,000 cash before you can start this.
Yep, which, as you say, tends to show that they're wanting that seasoned investor who's got rental properties, have been through the ups and downs of that, and have the capacity to take this investment on and go through any possible challenges it might have. So, further to that, as a guide, minimum household income, $200,000. Okay, if they've got 180, 190, it's probably going to be okay. But in the old days where a male applicant was on 80,000 and female applicant was on 80,000 or they were on 50,000 each, those deals will not fly anymore because they don't have enough income to service their current commitments and take on an NDIS property that takes 12 months to build and can have some vacancy periods. Again, it's probably not black and white, Debbie. So look, if we've got a client who's got an income of $150,000, but they've got $800,000 in a share portfolio, we would build the case, well, why would you not do that one? They've got plenty of liquid asset in the background to cover some of those instances. So it's not hard and fast, but it's certainly a general guide that the lender will be following pretty strictly.
Fair enough.
And you might have someone who's only got $190,000 worth of savings, but they want $500,000 income and they've got no debt. Well, you wouldn't say no to that. But if they've got 4 mortgages or 3 credit cards and a car loan, then it's more complicated, and the reason why they brought in some of these restrictions.
There was also restrictions regarding assets, I believe.
Yes, they're wanting 5% liquid assets. So if you're currently renting and you've never owned a house and all you've got in the bank is $250,000, you're probably not deemed the type of investor that they're looking for. They're wanting people who have real estate property, share portfolios, cash in the bank, substantially greater than their liabilities. What else have we got? Okay, yes. Now, the good part is this does not apply to owner-occupiers. So if you are an NDIS participant and you are buying a house for yourself or your wife, husband, etc., these do not apply to you. Okay? Those postcode restrictions do not apply.
That is good to know.
It does not apply. It also doesn't apply if you are a family member who is an investor, i.e. mum and dad buying it for their son or daughter to live in, who is going to be the tenant and obviously has their SDA program approved. The tenanting is guaranteed. So does not apply to owner-occupiers or investors who have put a family member in as tenant.
Noted.
What else? Equity releases. So quite often a client requires to do an equity release out of an owner-occupier house or an investment property to fund the deposit and fees for their NDIS purchase. Historically, what we would do is we would do their servicing calculator, put all their income in, put all their debts in, apply for a second loan of, call it $300,000 for equity release, proposed NDIS rent into the calculator, and if it fitted, away we go. The lender will not do that now. They will do a servicing calculator based upon your current income. They'll take the NDIS rent out. They'll take the NDIS debt out. So your personal incomes must be able to service your current debts and the equity release. You can no longer rely on the NDIS proposed income to help get you over the line. And that's probably where those $200,000 income requirement comes into it, to make sure servicing is there. If you are an existing client who has just finished their first NDIS property and you're wanting to pull equity out of that property to repay yourself the money that you lent it, so to speak, or you're allowed to go for another one, if that NDIS property is empty, they will not take any rent. So when you do a construction loan, they take the proposed rent. When you've got a finished product, if it is empty, they take no rent. If it's got one tenant in it, they take one tenant's rent. So if the proposed rent 12 months ago was $180,000 for 2 participants, and you've got one person in there now and on $70,000 rent, that is the rent that goes in the calculator. They will not use proposed rent on established stock. They are probably the main changes, Debbie, to be honest with you. So you can see cracking down on deposits, got to be bigger. You need to be in a stronger financial position asset-wise. You need to be on good incomes to be able to cover construction delays and tenancy vacancies. And you've got the due diligence up front by way of discussing with an SDA, civil provider, the tenanting in that location, and your accountant or financial planner as to what are the risks. Particularly if you're doing one in an SMSF, that's your retirement fund. As an SMSF and you're in your late 50s, 60s, about to retire, you don't want an empty house.
Absolutely.
House is your pension.
Yeah, precisely. So same rules apply to SMSF lending.
Correct.
Yep. Okay. Now, what if it's a built and tenanted property?
As in those restrictions?
Yeah, because it's obviously no longer a construction loan anymore. It's just a loan to buy a property.
Yes, so that's fine. They still only allow you to have 2, and you still must have 20%.
Yeah.
I had this asked of me yesterday, if it's established, can we go 10% because you don't have that construction wait time? And I did check with the head of Origin, and his understanding is that it's still 20% across the board.
Mm-hmm. Right, okay. Any difference for apartments?
No, same rules.
Same rules?
Yeah. Obviously, apartments is probably easier because they're cheaper. They're not $1.2 million properties like a house, so it's easier for clients to meet the savings requirement.
And there are no drawdown payments during construction. It's a single contract. So, okay. So where does this leave investors? I mean, what I mean by that is how many of the investors that you have been assisting with loans, would you say what percentage would no longer qualify?
3/4.
Wow. Yep.
Unfortunately.
Yep.
A lot of them have got 10% plus a bit.
Yep.
And that bit's for a rainy day. Or even if they've got 20% now, that's all they've got. And the last thing the lender wants is someone my age, 56 years of age, who's got $250,000 in the bank, a decent job, small amount of equity in an owner-occupier property, having to put your life savings into this transaction, not having anything left over. You guys have been working on $400,000 liquid assets, probably more achievable for someone in that age bracket. Someone in their 30s, it's a bit different. They've got a lot longer lifespan of work to build up their net worth. And unfortunately, I think a lot of investors saw this as a dream, almost winning lotto, and suddenly going to earn $180,000 a year. And it's not unachievable, but it's the timing of when that's going to take place.
Absolutely.
Look, I've spoken to a valuer who valued a house and land package at 1.1, and we asked him the question, if this was fully tenanted, what would it be worth? And he said, I walk in there, I see a whiteboard in the boardroom, I see staff walking around, there's timetables of who's doing what and where. Please, another $300,000-$400,000 on it. Well organised, going concern.
Yeah,
they can certainly work, most definitely. We just got to be a little bit stricter and do more due diligence up front to make sure our investors are not getting caught at the end.
Yeah, look, absolutely.
We're probably doing them a favour, to be honest.
I totally agree. I think that this probably, or something like this, should have been brought in a lot earlier. You know, we were doing our best to make sure that investors had the buffer, had the understanding of why they needed that additional income, steered them away from buying in areas that we were seeing even a year, 18 months ago, were looking to be oversupplied. But unfortunately, there was a lot of people out there selling these properties and not caring about that. Still going to the same lender for finance. So we are now seeing the result of that. So many people who've got an empty house, or they've got a house close to completion, they're not even able to engage a provider because the provider says, we've already got houses in that area, we can't tenant, we're not taking on any more. And at the end of the day, it's the investor who has a huge loan that they're not going to be able to service.
Of course, and the other part is, it's not just the mum and dad investors who are in this space. There are some huge corporations who are buying multiple properties, multiple apartments. Some of them have different borrowing. They get their wholesale funding from somewhere else altogether. So it's really hard to know how many are out there. I suppose, the perfect world could the NDIS and local councils get together, because when a builder puts the plans and specs into council,
the council knows.
They've got to get approved. It's got to get approved before they can start construction, so that there should be a mechanism to have better statistics to how we make that work. So I'll leave that in your hands.
Yes, that's what we're always trying to find better ways of predicting. But, you know, it's so limited, that information. Obviously, the lenders are a good source of that information, because I know that Origin, and as part of Colcap, is, I think they do probably 95% of the NDIS loans in the space. Would that be right?
That'd be correct. Obviously, some of the corporate investors can go back to their business banking models through their major banks. But
the majority.
Mum and dad investors got the market, basically.
Yeah, that's exactly right. Well, I think you have already summarised what these new changes are, but essentially it means that 75% of investors are now out of the market for STA.
And there's other things they can do. As they say, they can look at the apartments, because they're a different option altogether. And the first time maybe they go out and buy an investment property and dip their toes in the water to see what it's like. It's not so, there's a rental shortage, so they could maybe play that game first, build up some more knowledge and equity and income, and then get into the NDIS space.
Absolutely. And this is not something that's going to be going away. I think, we've got to oversupply in areas, a huge demand in others. We're going to see big shifts in the coming 5-10 years of supply meeting demand or catching up with supply. But we're also going to see shifts in the SDA incomes, I'm sure. Like we saw last year, a huge correction after the first 5 years, and that will happen again, no doubt. So, whilst we are in a maturing market, it's still got a long way to go.
Some of the things you've spoken about previously, investors maybe just need to open up a little bit to doing other things. There's the short-term accommodation, medium-term accommodation in the NDIS states, child safety, child protection. I've got a couple of investors who have got young kids in their homes because circumstances. So they're still making a good return on that in the health of society, etc. So, and there's still homes, which is obviously a discussion for another day. So there are other options for them. They get that robust tenant-in or that high-bid support tenant-in. There's certainly other options for them.
There certainly are. And look, we've already had this discussion on a recent episode that there's such a demand from providers for homes that are not SDA for NDIS participants, essentially still homes. And whilst we can't necessarily sell them or market them as sell homes, they are homes that are likely to be rented by still providers for NDIS participants. So, and they're the same price as a normal property. Great way to get into the investment game and also have an ethical investment at the same time.
But anyway, I'm sure there'll be more policy changes to come. So when they do, I'll certainly let you know and let your investor members know as well, because it seems to be the landscape at the moment with constant changes.
Absolutely. And so you did say that this will be reviewed in March, certainly the postcodes. So that will be interesting. So look, I think that wraps up, Paul. So thank you so much for your time. I really appreciate it, as always, your wealth of knowledge in the lending space here within the NDIS property investment world. Any last thoughts you wanted to leave us with?
No, look, and as we've discussed already, this is designed to protect investors. Okay, so if it does put you out of the market, don't be disillusioned. It's designed to protect investors so you don't have an empty house in 12 months' time, which you then go and sell for $200,000 less than what you paid for it. Don't want you to be in that position.
Absolutely. So look, anyone who still wants to talk more about this, we're always open to talking to anyone who has got questions over whether they may qualify or just whether this is an investment option for them to consider. And if it's not, look, we do have other alternatives that we can talk to you about. So do get in touch with us here at NDIS Property Australia. And if you do want to take it further and reach out and find out if you will qualify, if you think that you may be in one of those grey areas, we will, of course, refer you on to Paul and his team.
Well, good. Sounds good, Debbie. Thank you again.
Thank you very much, Paul. And we'll see everyone next time. Bye now.
Thank you. Bye. See ya.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and just share this podcast with those that could benefit. Until next time, catch you on the next episode.